All right, everybody, welcome back for another deep dive with me. Today, we're going to look at something pretty interesting. I'm always keeping an eye out for promising companies and
Always on the hunt, right?
always on the hunt. Exactly. And one that popped up on my radar recently is Siemens India.
Okay.
They just released their Q2, second quarter financials for fiscal year 2025.
Yeah.
And there's a lot to unpack there. So we're going to do a deep dive into their report, see what we can find.
Sounds good.
And hopefully by the end, you'll come away with a little better idea of whether or not you want to maybe think about investing.
For sure.
So the thing that really kind of, got my attention was their profit increase
Okay.
year on year.
Yeah.
A whole 45% increase.
Wow, that's a big jump.
A huge jump. And, on the surface, that's fantastic, right?
Right.
But we're going to look a little deeper because there's
There's always more to the story.
always more to the story.
Yeah.
So let's jump into some of the numbers. So their net profit came in at 830.7 crore,
Okay.
with a total income of 6,031 crore.
Okay.
Now, what's interesting is that while their profit went up, their total income actually dipped a bit.
Huh. That is interesting.
Yeah.
What do you think is driving that?
Well, that's what we're going to find out.
Okay, great.
But first, I just want to throw out another number. Their EBITDA margin
Okay.
was 17.3%,
Which means
which is pretty healthy. Maybe for our listeners who aren't familiar with that term, you could give us a quick.
EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Right.
And it's basically a way to look at a company's profitability without getting bogged down in the kind of the financial details.
Wow.
Like
debt.
Exactly.
Yeah.
Exactly. So you can really see how well the core business is performing.
Okay.
So in this case, that 17.3% suggests that they're doing a good job managing their costs and being pretty efficient.
Okay, so their operations are good. They're doing a profit.
Yeah.
That's great, but what about the future?
Yeah. That's a good point. You always have to look ahead.
Right. Well, they've got a pretty impressive order book.
Oh, yeah. What's it looking like?
34,152 crore.
Wow. That's huge.
Yeah. So that's potential future revenue just waiting in the wings.
That's a really good sign.
Yeah, it is a really good sign. But it's not all sunshine and roses.
Oh, okay.
So part of this profit jump that we saw was due to a couple of things. One was lower inventory costs,
Okay.
and the other was a one-time tax credit.
Ah, I see. So how much of this is like sustainable growth versus,
Yeah.
temporary factors?
Exactly. Yeah. Well, the tax credit, obviously, that's not going to happen every quarter.
Right.
But the inventory management is interesting because that could be a sign that they've...
Yeah, that they're becoming more efficient.
Exactly.
That's something that can continue to benefit them.
Right. So that's a good sign.
Okay.
So we've got a good profit margin, a big order book, but now let's talk about valuation.
Okay.
So Siemens India is currently trading at a PE ratio.
Price to earnings.
Yes, of around 55,
Oh.
which is pretty high. Maybe you could explain for our listeners what that means.
Sure. So the price to earnings ratio basically tells you how much investors are willing to pay for each rupee of the company's earnings.
Right, so a high PE.
Yeah, it can mean a couple of things.
Yeah,
It could mean that investors are really optimistic about the company's future.
right.
They think the earnings are going to keep growing.
Yeah, but it could also...
But it could also mean that the stock is overvalued.
Yeah. So is this optimism justified, is the question.
That's the question. Exactly.
And to figure that out, we'd have to look at how it compared to other companies in the industry.
Yeah, like ABB India or Schneider Electric.
Right.
See how they stack up?
See how they stack up and how it compares to Siemens' own historical PE.
Yeah, good point.
Okay, so that's valuation, but we also need to talk about their debt.
Okay.
So their debt has climbed to 2,640 crore.
Is that a concern?
It could be. Debt itself isn't necessarily a bad thing.
Right. It can be used to fuel growth.
Right,
Look-
exactly. But it depends on how it's managed.
So what do we know about how they're using this debt?
Well, we'd have to look at, is it short-term or long-term debt?
Okay.
What are they using it for?
Right. Are they investing in new projects or are they just using it to kind of cover day-to-day expenses?
Exactly. And to get a better sense of the risk, we should look at their debt-to-equity ratio.
Yeah, that's a good measure.
Basically how much of the company is owned versus owed.
Right.
And we should also look at their interest coverage ratio.
Which tells us how easily they can make their interest payments.
Exactly. And that's important because interest rates are rising.
Right. So if they have a lot of debt and those interest payments go up.
Yeah, that could eat into their profits.
Exactly.
Okay, so I think we've covered a lot of ground here.
We have.
Let's try to sum it all up.
All right.
So Siemens India, they're definitely doing some things well.
Yeah.
They're riding this wave of economic growth in India.
Yep.
They seem to be operating very efficiently. They've got a huge order book full of potential.
For sure.
But there's some things that investors need to be cautious about,
Absolutely.
like that high valuation
Yeah.
and the rising debt.
Yep.
So, you know, I'm not going to tell you whether or not to invest in Siemens India,
Right.
but I hope this deep dive has given you,
The tools you need.
yeah, the tools you need to kind of make your own informed decision,
Exactly.
do your own research,
Look at those financials.
compare to the competition.
And most importantly, think about your own risk tolerance.
Exactly.
That's how you make smart investments.
All right. Well, that's all the time we have for today.
Thanks for having me.
Yeah, this was great, and we'll see you next time for another deep dive.
See you later.
Bye.
Bye.